welcome to the Explainer. For a while now, high interest rates have been great for savers, but the tables are turning. So today, we're going to break down exactly where to put your savings to make sure your cash is working for you in this whole new economic landscape.
All right, let's jump right into it. The financial world is, well, it's always on the move, right? But this time, it's a big shift. And if you've got a savings account, you've got to ask yourself this one crucial question. Is my money in the right place at the right time?
So just how big of a shift are we talking about here? Well, take a look at this number. According to a recent bank rate forecast, the Federal Reserve is projected to cut interest rates by 0.75%. Now, that might not sound like a lot, but it likely means 3 separate quarter-point cuts. And believe me, for anyone with savings, that is a huge deal.
Okay, so here's the bottom line. For years, we've had these rising rates, which was fantastic if you were saving money. But now, the tide is turning. We're heading into a time where rates are expected to drop. And that, of course, directly hits how much interest you're earning on your cash.
And this quote from Ted Rossman at Bankrate really nails it. He says, individual quarter-point cuts are not super consequential, but when you stack up a bunch of these, there's already been some relief. So it's not about one single event that's going to rock your financial world. It's the trend. This steady drip, drip, drip of falling rates is what makes deciding where to park your cash right now more important than ever.
All right, so let's start building a strategy. What are our options? First up, we've got the High Yield Savings Account, or HYSA. I want you to think of this as the super flexible, come and go, as you please, parking lot for your money.
So what exactly is an HYSA? Well, at its core, it's basically a supercharged savings account. You get all the easy access you're used to with a regular account, but with way, way better interest rates. And of course, it's all FDIC insured, so your money is safe. And when I say better rates, I'm not kidding. Look at this. Even with rate cuts looming, the top HYSAs are still offering some seriously competitive returns. We're talking up to 5% APY. That is a night and day difference compared to what you'd get in a traditional savings account. But of course, there's a trade-off, and this really gets to the heart of it. The pro is incredible flexibility, right? Your money's there whenever you need it. But the con, and this is a big one, is that amazing interest rate isn't guaranteed. It's variable. So, as the Fed cuts rates, you can bet the rate on your HYSA is going to follow right along.
Okay, let's look at our second option, the Certificate of Deposit, or CD. Now, if the HYSA is that flexible parking lot, a CD is more like a reserved, long-term parking garage for your savings. It's all about one thing, stability.
So what's a CD? It's pretty simple, really. It's a deal you make with the bank. You say, hey, I promise not to touch this money for, say, 1 year or 3 years. And in return, the bank says, great, we'll guarantee you this fixed interest rate for that entire time, no matter what happens with the Fed or the market. It's locked in. And that is what makes a CD so powerful when rates are expected to fall. You get to lock in one of today's awesome high rates and just cruise right through all those future cuts. But here's the catch, and it's a big one. You're sacrificing freedom. Your money is locked up, and if you need it early, you're going to pay a penalty. All right, so let's put them head-to-head, the showdown. Flexibility versus stability, this right here is the central decision every single one of us with savings has to make right now. What do you value more, having instant access to your cash or knowing your return is absolutely guaranteed?
And this table just lays it all out, plain and simple. Need to get your hands on your money anytime? HYSA is the obvious choice. Want to lock in a rate so it can't go down? CD is your best bet. It really comes down to which column here speaks to your personal situation. It's a classic risk-reward scenario, the risk of a falling rate versus the risk of needing your money.
So I want to be really clear about this. Neither one of these is better than the other. It's not about finding the one magic account. It's about matching the right tool to the right job. It all depends on what you're trying to do with your money. Okay, let's walk through a few real-world examples. Are you building an emergency fund? Well, you need that cash to be liquid, no questions asked. So an HYSA is perfect. How about saving for a down payment on a house you plan to buy in 2 years? A 2-year CD is a brilliant move. You lock in a great, predictable return for that exact timeline. Or maybe you're just not sure what's next, and HYSA keeps all your options open. See? Tool for the job. Okay, but here's where it gets really interesting. Just when you think you've got it all figured out, there's a twist. The experts, I'm talking the big financial institutions whose entire job it is to predict this stuff, they don't actually agree on what's coming next. I mean, just look at this chart. It's kind of all over the place, right? You've got Bankrate saying, yep, 3 rate cuts are coming. Then JP Morgan comes in with, nah, maybe just 1. And then Morgan Stanley is over here suggesting that with a strong economy, we might see few, if any, cuts at all. It's a huge disagreement. So why am I showing you this? Because it proves one thing. If the experts can't agree, trying to perfectly time the market is, well, it's a fool's game. Your decision on where to park your cash shouldn't be a bet on who's right. It has to be a personal strategy that fits your goals and, just as importantly, your own comfort level with risk. So at the end of the day, it all comes down to this one simple question. As we head into this period of falling rates, what are you more worried about? Is it the fear of missing out on locking in a great CD rate before they're gone? Or is it the risk of having your money locked up tight when you suddenly unexpectedly need it? Answer that question for yourself, and you'll know exactly where you should be parking your cash.